All right, today we're not just going to define a term. We're going to deconstruct a core framework that is absolutely essential for anyone who's serious about their financial future or their business strategy. We're going to break down the idea of a risk profile, not as some static label, but as a dynamic tool for making much smarter, clearer decisions.
So let me start by asking you a question. What's your biggest financial blind spot? Is it that feeling you get when you're trying to figure out just how aggressively you should be investing for retirement? Or maybe you're wondering if taking on that big new business loan is a brilliant move or a total disaster waiting to happen. These moments of uncertainty, that's precisely where having a crystal clear understanding of risk becomes your most valuable asset.
And the solution to that uncertainty is what we call a risk profile. Think of it like a diagnostic tool. It's a structured way to evaluate two really critical things. First, your willingness to take on risk. That's the psychological side of things, your gut feeling. And second, your actual ability to handle it. That's the financial reality, the hard numbers. This is the framework that shines a light on all those blind spots we were just talking about.
Now, to do this right, we've structured our analysis just like a top-tier consulting project. First, we'll lay out the core framework. Then, we'll do a deep dive into the two main types, individual profiles and company profiles. After that, we're going to move from theory into action and show you how to build your own. And finally, we'll wrap up by talking about why this isn't a one-and-done task, but a proactive, ongoing strategy for success. Okay, let's jump right into our first section, the core framework. Before we can start picking apart the components, we really need to understand the fundamental structure of a risk profile. And to do that, we're going to use a core principle of clear, structured thinking.
The key here is a little acronym consultants love, MEIS. It stands for mutually exclusive and collectively exhaustive. Sounds kind of jargony, right? But all it really means is we're breaking things down into clean, separate buckets so we don't miss anything and we don't double count. See, a risk profile isn't this one monolithic thing. At the highest level, it splits perfectly into two distinct dimensions that, together, cover the entire landscape.
And here they are. This is our level 1 breakdown. On one side, you have the individual profile. This is all about you and your personal finances, how you invest, how you borrow. And on the other side, you've got the company profile, which operates on a totally different scale, analyzing threats to an entire organization. They are two fundamentally different applications of the exact same core idea.
So let's do our first deep dive and zoom in on individual profiles. We're focusing on you, but even this category isn't quite as simple as it looks. There are actually two very different ways your personal risk profile is looked at and assessed. Think of them as two sides of the very same coin.
This table breaks it down perfectly. On one side, you've got the investor lens. Here, the big question is all about your appetite for growth. We're looking at things like your time horizon and financial goals to build an investment portfolio that matches that appetite. But then, on the other side, there's the lender's lens. And this isn't about your feelings. This is about cold, hard numbers. The question here is simple. Can you pay us back? Lenders are looking at your debt-to-income ratio, your credit score, all to assess your capacity to repay. You've got to understand both lenses to be financially healthy. So, let's double-click on that first column, the investor lens. How does your unique tolerance for risk actually translate into a tangible real-world strategy? Well, the answer lies in one of the most fundamental concepts in all of finance, asset allocation. This is where the theory gets real.
Let's start with a classic example, the balanced profile. This is the famous 60-40 split. 60% of your money goes into stocks for their growth potential, and 40% goes into more stable things like bonds. This profile is all about finding a middle ground. You're trying to capture some of that market upside while still having a cushion when things go south. It's the benchmark for someone who values both growth and, being able to sleep at night.
Now let's look at the aggressive profile. Picture a younger investor, someone with decades to go before they even think about retiring. They can handle a lot more risk because they have time on their side to recover from any market downturns. So their portfolio is skewed heavily toward growth assets like stocks. The goal here is to maximize those long-term returns, and they accept that higher short-term volatility is just the price of admission for that potential growth.
And finally, we have the conservative profile. Now imagine that same person, but fast forward 30 or 40 years. They're just a few years away from retirement. Their goal is no longer about hitting home runs, it's about preserving the wealth they've built. They simply can't afford a major market crash. So their allocation flips completely with a huge emphasis on stable, income-producing assets. Now here's the crucial point. The same person can be all three of these archetypes at different stages of their life. The real danger is being in one stage, but acting like you're in another.
Okay. We have thoroughly deconstructed the individual profile. So let's pivot now to the second half of our core framework, the company risk profile. Here, the stakes are so much higher and the variables are way more complex. We're talking about the health and the very survival of an entire organization.
And just like we did before, we're going to apply our MECE framework to break this down. Company risk isn't just one big, scary blob. It splits cleanly into two categories. You have internal risks. These are the threats that come from within, things like operational failures or weak compliance. You manage these with strong internal controls. Then you have external risks. These are threats from the outside world, like new competitors, economic downturns, or supply chain problems. For example, for a software company, an internal risk might be a huge bug in their code, while an external risk could be a new data privacy law that totally upends their business model.
So, why is this so critical for a company? Because unmanaged risks can create a catastrophic negative feedback loop. Just imagine a company ignores an internal risk. Let's say it's outdated cybersecurity. An external hacker exploits it, causing a massive data breach. Well, that triggers a costly lawsuit and huge financial losses. The public image is shattered, customers leave, investors panic, and the stock price tanks. In the worst-case scenario, that whole chain reaction can lead straight to bankruptcy. This isn't just a paperwork exercise, it's a survival strategy. Okay, so we've analyzed the what and the why for both individuals and for companies. Now let's get to the how. This section is all about turning this abstract framework into a concrete, actionable plan that you can actually use to assess your own investor profile. It really boils down to a simple three-step process to get you started. First, evaluate your risk tolerance. And you have to be brutally honest with yourself here. How did you feel during the last big market correction? Were you panicked in selling, or did you see it as a buying opportunity? Your gut reaction is a really powerful indicator. Second, define your time horizon. How many years do you have until you need this money? The longer you have, the more risk you can generally afford to take. And third, set your financial goals. What is this money for? A down payment on a house in 3 years needs a much more conservative approach than a retirement fund that's 30 years away. All right, let's pull back up to the 30,000-foot view for our conclusion. Understanding and building your risk profile isn't a project you finish and then file away in a drawer. It's a dynamic, ongoing process that is absolutely fundamental to long-term success, whether you're an individual investor or a billion-dollar company. It is a strategic imperative. This quote from our source material just nails the core message perfectly. And the key word here, the most important word in the whole sentence, is readdressing. Risk isn't static. For you, life events like getting married, having kids, or changing your career will completely alter your risk profile. For a company, market shifts and new technologies are constantly introducing new risks. The process of evaluation has to be continuous. And that brings us to our final thought. A risk profile isn't a tattoo. It's a living document that has to evolve as your life changes. The aggressive investor of today might be the conservative retiree of tomorrow. The low-risk company in a stable market could face an existential threat literally overnight. So, I'll leave you with this one question to think about. When was the last time you truly sat down and reassessed yours?